Hey Shane, how's it going?
You know what? It's going better than I expected it to be, given the hurricane that was coming for us for a while there. So glad we didn't evacuate or do anything because we got a little bit of wind and a little bit of rain here just north of Tampa. I got one tree down in the neighborhood, but otherwise we made out pretty well, especially compared to the horrific stuff they were showing you on the news if you're watching that down south in like Naples and Fort Myers and gosh, Cape Coral, some of those other places just got demolished. So anyway, we are blessed here, and I don't know, maybe we'll look for some opportunities to go down and try and help some other people out who are a little less fortunate, this weekend. So, but yeah, man, I got a generator already, and kind of prepped things for the worst. And I was telling Ken, I don't know if it was on a call with you or not, but was telling Ken the more time and money we spend getting prepared, the less likely it'll be that the hurricane comes for us. So that's pretty much how it worked out. And don't get me wrong, I'm glad we prepared, but I'm glad we didn't like get in our car and leave and evacuate or go anywhere because that would have been pretty unnecessary. So yeah, things are good, man. Better than I expected to be. I didn't even know if we'd have power today, but we never even lost power. So very, very lucky.
Good to hear. Well,
You know.
as for the markets, it's been a little chaotic. So today's September 29th, when we're recording this, and yesterday we had a heck of a rally. Energy led the way. I think it was up about 5%. And this morning now we just reversed all that. So here's
Very quickly, reversed it all. Made fresh lows for the year this morning, man. It's pretty gnarly. I think it's probably best just to zoom in from this. This first one here on SPY just shows you that we are below our our 2020 close. So we've erased the entire year of 2021 where the market was up 27% for no reason with GameStop and AMC leading the way. So this just pretty high level overview of the S&P 500 and where we're at over the past couple of years. The next slide will give us a little better, clearer look at where we are right now. And the prior 2022 low close has been breached. And as of this morning, well, actually 2 days ago, we made a new intraday low as well in the SPY. And now we're kind of just grinding around down the bottom. When I took this screenshot about 30 minutes ago, the market was a bit higher than where it is now. But yeah, it doesn't look good. We've been saying on this call that the lows probably weren't in for the year, even during that 20% bear market rally we saw for July and August. I mean, I don't know how many times we said it, you and I both, but I was never convinced that the lows were in for the year. And that doesn't mean we don't buy stocks, by the way. We could be wrong. We often are wrong. I personally am wrong a lot. And so, doesn't mean we weren't buying some stocks here and there. But we never put all of our money back in. We were never aggressively buying stocks. Um, and as of the past couple of days, we stopped out of a bunch of the ones we bought. So glad we never took full positions and glad we kept the stops pretty tight. And we'll see what happens from here. But I don't, you know, we've talked about it a bunch on this call too, where seeing that consolidation, it's not just like a go down, make a low, and then bounce like it did back in June. Now we're kind of consolidating around this level. There's people who want out, there's people who are trying to buy the dip, and all that needs to sort itself out. And once that settles down and buyers and sellers kind of equalize, people who are taking profits off of their shorts, are forced to buy the market here. All kinds of stuff's going on. So this consolidation is good, leads me to have a lot more faith in whatever direction we exit this consolidation from. If we bounce from here, I might have a little bit more conviction to get long. But if we drop from here and start making fresh lows, I think that will give me more conviction to stay very aggressively short in my personal accounts and hold lots more cash for clients. So we'll see what happens over the next couple of days and weeks. But there's really nothing to be bullish about. Sentiment isn't even bad enough to be contrarian long. Just pretty brutal. I take that back. Sentiment's gotten pretty bearish, but I don't know. I think for good reason. And I've been saying all year, I don't think anybody's bearish enough. And here we are at the lows again. So
Mhm.
I don't know what your thoughts are, but looks ugly. Could end up looking a lot uglier from here.
Yeah, it's kind of the same and something I was looking at from the circle you drew here when the Fed made their announcement to where we are now. I think we had 7 red days in a row. And I went and looked at '08. We never had a period like that from what I could tell. So it's natural that we would get a bounce here. Also, you had that low there. Rarely do you hit that on the first attempt and break it. So, it's normal we're consolidating here. Be great to see some rapid bounce, but right now it's been a short-lived bounce yesterday, little consolidating today, and I don't know where we go, but I'm same camp as you. Big picture bearish, but we could definitely see a little bit of a bounce right here and maybe come up right into this area. So that'd be what, 380 and roll over, but nothing to get excited about.
Yep, totally. I am not bullish here. I don't see anything to get excited about on the bull side. So, um, got a ways to go yet before anything like that's gonna happen.
hmm And then NASDAQ here, just more of the same, really. I don't have anything to add on this chart. Right back at that low. We'll
Yeah, I
we'll
mean, it
see.
hasn't added a fresh low yet on the Qs. So that's interesting. We haven't broke the lows yet, but gosh, the Qs is down a lot more. And that's the function of the rates going higher. Qs is down 31.99% year to date as we speak over the past 1 year, which is why I put that red line on there from September 29th of 2021. So over the past 1 year, it's down 24.81%. So pretty brutal to be a long only investor in the tech sector with interest rates rising so rapidly and the currency rising so rapidly. This is just a recipe for disaster. And I think easily, Qs could break down from here and drop straight to that pre-COVID high if it doesn't hold up here. So you can see momentum trying to curl up though. If you zoom in, go to the next slide, you can see that momentum's trying to curl up. So, I could see a bounce. I could see holding here for a little bit and maybe just working off that momentum like in time instead of in price and maybe dropping to a new low. So yeah, it doesn't look too good from anywhere I sit as far as going long stocks. So caution is the name of the game.
Agreed. And then LQD, so 60/40 portfolio. That model certainly has not worked this year.
No, getting demolished. It's worsened by 2% since we did this call last week. So it's not getting any better at all. And dang, I'm about to go short some snow. I got stopped out of this short already once today, and now it's rolling over again. The volatility is just killing me in my personal trading accounts right now. We were talking about that just a minute ago before we hit the record button, but man, I tried to catch a bounce in the Qs, got stopped out of that this morning. Tried to short Snowflake, got stopped out of that also like this morning. And it's just like it's super frustrating over the past couple of days. So anyway, whatever is what it is. I'm not going to trade while we're on the call. I have to wait and see how it shakes out after we're done
And
recording this.
that's something too, just to give people a little education on that. In a bear market like we're having right now, when the VIX is up over 30, this, whether you're short or long, this is the toughest trading environment you could possibly face.
And
It's,
you just got to follow your stops, man. I mean, you got to keep
yeah,
them tight and you got to follow them. The danger is like, I could widen the stops and make the position smaller. I think that's something that is worth consideration, just because of the way that I place my stops at either the highs of the day or the lows of the day. Like a lot of things are taking out the lows of the day and then bouncing, or taking out the highs of the day and then dropping to a fresh low. And so, you got to account for that volatility somehow. So far, I've just been keeping my stops tight and, you know, being willing to take those small losses. Um, I'm still up for the year, so I don't have much to complain about. I think I'm basically flat for the month of September, even, and geez, the market. I don't know, what is the S&P 500 down now for the month of September? It bounced about 4% to start the month, and now down 8.26% for the month. So I mean, flat month isn't the end of the world, but I'd rather be up,
yeah.
rather be up than down. So Anyway, that's not what we're here to talk about. Yeah, like you were saying, the 60/40 portfolio. If you want to just go back up one quick second, my main comment there is that last week this said down 20 point something percent. As of this week, it says down 22.95. And again, that yellow line or orange line, whatever color it is, the orange and the blue, those are highly correlated. Like they're supposed to be inversely correlated. That's what your advisor told you if you're in a 60/40 portfolio. He told you the blue line was going to zig when the orange line zagged, and that's not happening. It's not going to happen anymore until the Fed stops raising rates and interest rates overall stop going up. And so this portfolio is pretty dead meat. And I would not want to be in it. If you're stuck in it, I don't know that I'd go like sell everything at the moment, but I would definitely develop a plan, because interest rates might be going up for the next 30 years on average. And the 60/40 portfolio is not going to work over the next 30 years like it has worked over the past 30 years. And pretty much everybody who's in the market recommending this type of portfolio now wasn't managing money in the 70s. So they don't have any idea how bonds and stocks are correlated. They have an idea how they're inversely correlated during a super long bull market in bonds. But if we're in a super long bear market in bonds, which bond market cycles tend to be 30 years or more, nobody, including myself, has any idea, how that's going to work going forward. And so just sticking with historical correlations that may not hold true is a recipe for disaster. And I would not want to be in the 60/40 portfolio. I'd rather
Right.
own 40% gold than 40% bonds. And gold doesn't do well when interest rates are going up either. So anyway, yeah, that's really the point there. I think we're going to keep an eye on this maybe in subsequent weeks just to see how it does.
And then, so here's crude oil. Energy got one heck of a bounce yesterday. That's what you're seeing right here, but that looks like a nice entry to go long. But when you're stuck down under this resistance, there's no telling if that'll hold or not. So,
Oh, yeah, you're stuck under that resistance. You're stuck under the 50-day moving average. You're well under the 200-day moving average. You're below that downward sloping purple line that's connecting the lower highs. This is not a place that I'd be going long. Obviously, I think what's going to happen is you rally up into all those levels of resistance around 85, and then boom, we drop further. I think you drew this arrow and said 27% down to the next support. That was a couple weeks ago now. I haven't really changed that message, so we've dropped a bunch and then bounced a little bit since then. So I don't know, until we get back above that purple line, back above the 50-day moving average. I still think the trend is down, and you want to sell rips and oil.
agreed. And energy, you're seeing that same thing. So, broke down from right here, bounced, looks just like oil. Is it going to hold? I don't know, but now you're under these averages, and I don't like being under those.
No, I mean, I'd be a little bit more constructive there, just cause, again, as long as the economics are such that as long as oil holds above about 60 or 70 a barrel, these guys are going to be making money. It's also up, XLE is still up 30% for the year. So it's the strongest sector. It's the cheapest sector. It has fundamentally good economics underlying it. So, energy is still the only thing I can think to go long. And so we definitely have some negative momentum. So at the bottom, the MACD is red, but it is improving, right? So we'll see. I think the next move is probably higher, but whether it breaks out or just makes a new lower high is, that remains to be seen. I could easily see a rally up to the 200 and a drop, and a rally up to the 50 and a drop, and then a rally up to, about 80, where that descending purple line is, that's connecting again the lower highs. All that's resistance for XLE, but I don't trade crude, and so I'm not going to trade crude. And I think if you want to, if you have a target allocation to energy, now is a good time to at least take a nibble on that. And probably set your stop right around 65.33 is that level so far. So as long as we hold above there, I think it's probably okay. But certainly wouldn't be taking this for a trade in my accounts. This is
Right.
more of an investment deal.
Agreed.
And there's nowhere else
And
to go in this market. I mean, just yeah, don't go buy Bitcoin. Look at this turd. Ugh,
yeah, Bitcoin's
man,
been
that
a
looks
tough.
brutal.
It's just every classic sign of something in a bearish trend. You've got resistance right here, came up, hit that heavy sell off, and now it's just consolidating. You can barely see it on here, but there's a wick right under the cross there where it wicked up, and it's just not showing any ability to get an uptrend in place.
Nope. It just needs more time to work itself off. I mean, it's been trading in this range since middle of June. So that's, you know, I think that's constructive. The longer it builds this base, the bigger the move is going to be higher if it actually ends up breaking out. But it could do this for another 6 months, and the 200-day moving average will just keep coming down towards, the current price. And then it's going to start getting interesting. Like when the 50-day and the 200-day and the price all kind of come together in a tight range. If it can break out from there, that's where I'm going to go crazy long. But until then, and that's a big if. It might break down from there, and you would want to go crazy short. Um, so yeah, we'll see what happens. But right now, I don't see a whole lot of reason to be getting aggressive. Tech stocks or other stocks or Bitcoin or any other crypto. So
No.
just sit and watch.
And then here's the most bullish chart we have.
Oh yeah.
Yields just shot up on the 10-year, and that certainly scared a lot of or equity holders. So yesterday, I thought this was interesting. Yesterday with this huge sell-off in yields, and that confirmed to me that run up, but it didn't hold. But that's what I was looking for, is just equity investors watching yields. They see those go down, start to feel a little better, but I think it's just a 1-day move.
This is the most watched interest rate in the entire world. It influences the pricing of more things than any other thing that I mean, if any one chart, I mean, even more so than dollars, because I think dollars are reflected in this move as well. So we've got a dollar chart coming up, but I think this is the most important chart in the market. And as long as this thing is trending higher, um, asset prices are going to struggle. And, I mean, the rate comes down because when people see over 4% in the 10-year, they go buy 10-year bonds. They're like, gosh, if I could, we have plenty of clients who, if they earn 4% for the rest of their life, they're going to live happily ever after. There's no risk to their lifestyle. They don't have to sell their vacation homes. They don't have to eat cat food. They don't have to live with their children. They don't have to skip vacations or meals or anything else. So, I mean, when you consider like, hey, I can get 4% and the risk-free rate by loaning money to the U.S. federal government, that 4% is going to capture some capital. Like it's going to attract capital, and the more people that start buying bonds at 4%, well, what happens? The price goes up and the yield goes down. So it's not surprising to me that we had a little bit of a pullback after that kind of parabolic breakout move. I will be surprised if it drops any lower than the 50-day moving average. I don't expect it to go anywhere near the 200-day moving average at this point. Maybe as the 200-day moving average comes higher, but I'd be shocked to see rates under 3% on the 10-year Treasury anytime soon, at least until the Fed, stops their hike cycle and backs off of their hawkishness. So the longer this stays high or the higher it goes, the worse it's going to be for asset prices. In the NASDAQ and the S&P 500. So, yep, this is, that said, if you want to buy 10-year US Treasuries, we can help with that. Give us a call. We lots of people doing that kind of stuff right now. In fact, it's funny because, well, we got the yield curve coming, chart coming too, but you can get the same 4% by only loaning the money for a year or 9 months.
Yep.
So you don't even have to do it for 10 full years to get 4%. So that's what we've been doing a bunch of, is buying US Treasuries that mature in 3 months, 6 months, 9 months, 12 months. And then we'll see what happens as that money comes back to us 3 months from now. Where are rates? Do we want to put the money back into a 3-month treasury? Or do we think stocks have bottomed 3 months from now and rates are coming down? And so maybe we want to take that that maturing 3-month treasury and put it into the stock market. But that's what we've been doing a lot of now, is just buying US treasuries that mature, in kind of a ladder, right? So they'll start maturing in January, and some will mature in February, and some will mature in March and April and May. And every time one of those bonds matures, we get our principal and our interest back, and we get to decide what do interest rates look like? Do we want to do another interest rate investment, or does the stock market look like, it's a buy and we can shift that money back to stocks? So
Hmm.
that's where we're sitting right now, as we wait for the Fed to back off from its hawkishness.
Yeah, this will be interesting. So, back to rates here, the yield curve, I mean, it just looks atrocious. So it is very inverted, and that is certainly not bullish for stocks or the economy.
Nope, and it's staying that way. It's can't even really get a bounce. So the yield curve is not going to stay inverted forever. The longer the 2-year yield is higher than the 10-year yield, the worse it is for the economy. But as people see that, they will buy the 2-year bond over the 10-year bond, and will push this thing back to positive. So that it doesn't mean that once the yield curve normalizes and becomes uninverted, doesn't mean that we're out of the woods at all. It just means we're closer to the recession beginning. And personally, I think we've already been in a recession for the entire year 2022. I think GDP has a very good chance of coming in negative for the third straight quarter, and we'll see then if the government can finagle a way to say we're still not in a recession after 3 consecutive quarters of
Hmm.
declining GDP. So right now it doesn't look good though, and this is certainly indicative of an impending recession.
Yep. And then here is a strong dollar, and this is not helping anybody other than those who are just sitting in cash. Certainly not bullish for equities. And this is just something else. I've never seen the dollar move like this, but it just keeps ripping higher. So quite the chart.
Yeah, and yesterday was a real, like, yesterday apparently the UK, the England markets in England, like, almost like had a major credit crisis meltdown, to the point where a bunch of pension funds um were basically getting margin calls, and what they were doing was selling long-term bonds to pay off their margin calls. And the Bank of England, who was originally planning to start selling bonds off of their balance sheet, just like the federal government in the United States is doing, they actually flipped and decided to start buying, I don't know, I think it was 60 or 70 billion dollars of those long-term bonds. I mean, go look at, I should have put a chart in here of the GBP, the British pound. But dude, the pound the other day, like, this is a currency. Currencies shouldn't move, 2 or 3% in a day. That's just, it's kind of like unheard of. Those are major volatility events. Well, over a 2-day period, Great British the British pound dropped 14.69% to its lows versus the dollar. Just one day. This was what was it? It was 9/26. So what day was that? Was that Monday? Yeah, Monday. Monday alone, the thing dropped 12.32%. And then it immediately spiked back up. It's now up 15.5% off of the lows that it hit on Monday. And that's because, the government is intervening. But it's just not a good situation when, they just can't stick to their game plan of actually, selling bonds off the balance sheet. They've got to intervene to bail out pension funds in the country. All the while, the Fed is still raising rates faster than the Bank of England. So the faster the United States raises its rates, the more capital that attracts, and it puts pressure on the pound to go even lower. I mean, eventually the pound will probably bottom, but we're at like almost. I mean, we got below parity on Monday. Uh, British pounds were 95 cents on the dollar. I mean, I remember growing up when it was like $2 for a pound.
It was certainly, it was always more expensive to go there. That's for sure.
Yeah, I mean, just in the past 3 years, it was as high as $1.42 for a pound. But I swear, like, when I was like growing up, it was like, every time you did a conversion to pounds, yeah, I mean, it was, yeah, there you go, let's see. what was the high? Just in the past 10 years, it was 2.11 pounds per dollar back in 2007 before the great financial crisis. That's kind of what I remember, is like pounds were expensive. And wow, what a fall. I mean, that's down 53% to the lows on Monday. That's crazy. So for a currency, it's unheard of. And the dollars are only getting stronger because if we're headed into a recession, what would you rather own? Pounds or dollars? I mean, dollars.
Yeah.
That's what you'd want to own, dollars. Everybody in the whole world wants dollars.
And it's always important to remember too, is as inept as our government may seem, they're the nicest house on the rundown block, or the, cleanest shirt and
Yep.
laundry, so to speak. So it's a great place to put money, is in the US.
Comparatively. But that's where Bitcoin starts catching a bid too. And you're like, gosh, these guys are bankrupt and they can print as many dollars as they want to. Bitcoin doesn't have that problem. And so that's, maybe that's what'll finally put a floor into Bitcoin when people want out of the, like, eventually the dollar is going to fall. I mean, it was obvious that it was going to fall from this high around 114, at least have a little pullback. So selling the dollars, where do you put them? How do you go short the dollar? Well, buy anything else pretty much, right? Buy anything. So anyway, dollars has been the place to be all year. I think that's probably going to remain the case, at least until the Fed stops hiking, and maybe even until they stop selling selling assets off of the balance sheet, which they haven't even really gotten started doing yet. So yeah, anyway, talk that to death, but the dollar is a great place to hide.
Yep. And then here's mortgages. I think this chart's just more alarming if you're trying to buy or just wondering where the real estate market's going. I've heard headlines, mortgages up at 7%. Right now we're looking at 6.3 on this. Those are just numbers that don't make you want to go buy a whole lot of house.
No. And the reason I threw this chart in, because it's not updated, mortgage rates get updated by Freddie Mac on Thursdays, but TradingView doesn't update their chart until the following day, tomorrow. So this is showing 6.29% right now, but that's actually changed. We'll see on the next slide that mortgage rates have gone actually closer to 6.7. But the reason I put this on the list is because going all the way back to when we first started doing these calls back in May, or maybe even before that, I don't remember when we started doing these weekly
I think
calls,
it was
but
April.
it's been a lot of fun. So we originally broke above that 4.95 yellow line on April 14th of this year. And we said it. I know I said it. I don't know if you believed me, but I know that I was pounding the table and I said it's going to 6.81. That's where we're going. It's going to hold above 4.95, and mortgage rates are going to go back to at least 6.81. And then we'll see what they do from there. The next level after 6.81, by the way, is like 8.62. So if we get through 6.81 and hold, it's going to keep going even higher. So anyway, we were April, and it's now September and almost October. So we're like 6 months in advance. So if you were watching this call back then and you were in the market for a house, I hope you took our advice and went and got a mortgage done at a much lower rate. I know you did, Mr. Kyle.
Yep.
You got it on that pullback right towards 4.95. When was that? That was like early August.
Went long right there. So
yeah,
early August. Nice little trade, but
yeah, did a good job there. But yeah, I mean, so we nailed this. We've been all over this, and again, it's it's fundamentals. It's really technicals backed by fundamentals. I mean, you see these levels; they're very clear, they're very obvious, and then you see the fundamentals behind it, and you're like, "Yep, that's what's going to happen." Sometimes this stuff's easy, and in hindsight, we absolutely nailed this call. If you go to the next slide, you will see that as of this morning, 30-year fixed rate mortgage is now on average 6.7%, which is higher than during the financial crisis. The high back then was 6.63%. And so, yeah, it's pretty brutal. Pretty brutal. That'll bring house prices down quite a bit, because with interest rates that high, you can't quite afford to buy as much house. But it's a great great illustration of why when money is cheap, right? And by the way, 6.7 is still kind of historically not that expensive. It's pretty average, you know. But over the past, like, 5-10 years, you should have borrowed as much money as possible to get as much house as possible, because you're paying, like, 30 years from now, government's just going to keep printing money. Inflation's going to keep happening. There's never going to be any serious deflation if they have anything to say about it. So the whole way a mortgage works is that if you borrow, say, $100,000 or $1 million today, just for example, and you're paying that back with dollars that are 20 years in the future or 30 years in the future, those dollars 10, 20, 30 years from now aren't worth as much as the dollars today. So when you borrow it, you get the dollars today, and you're paying it back with dollars from the future, which aren't worth as much. And that is why the government always wants a little bit of inflation, because they're the biggest debtor on the planet. They borrow more money than anybody else, and they want to pay it back with dollars that aren't worth as much. That's why they print them to make the payments. So anyway, just an interesting illustration that when money's cheap, borrow as much of it as you can, and then
Yeah.
buy assets that will appreciate. That is the name of the game.
And it's important for people to know too, if you're in the market for a house, looking at the 10-year treasury, that's the quickest snapshot every day to get an idea where it's headed. That's kind of the benchmark that
For
sets
direction.
this up. Yep.
Yeah. Yep. Agreed.
And then here's our chart we go back to every time, is just looking at these rallies in '08 and realizing that, you can have these big rallies. It does not mean it's over. It can just keep getting the rug pulled and sell off really hard.
Yep. And if we were looking at the NASDAQ during like 2002, there was a 44% bear market rally. So the NASDAQ went up 40 some percent, and it was still in a bear market and went on to make fresh lows. So yeah, bear market bounces, bear market rallies, whatever you want to call them, they can be vicious and they could suck in a lot of people. But people who are watching us and listening to this call will not be fooled the next time that happens.
And then here, just balance sheet again. We brought this up last time, but
This one hasn't been updated from last week either. It shows the exact same number. So they're supposed to be bringing the balance sheet down, but a couple weeks ago during the course of the week, the balance sheet actually grew. And that's a function of the Fed talking out of both sides of their mouth and being very heavily involved in the overnight repo market, which is not a good sign. When the Fed has to be that heavily involved in overnight lending, it's because the economy is not in very good shape. So we'll see what happens. Maybe by next week, TradingView will have this updated, and maybe we'll see a tick lower in the size of the balance sheet.
And then Shane, tell me about this one. You've got the implied Fed funds, and just so people understand, the Fed funds rate, that is the rate the Fed sets to do overnight lending to banks, and that's really the key part that they control within the curve. Certainly that is influenced by inflation. So Shane, if you want to just talk about this one.
Yeah, I'm not going to beat this to death. The reason I highlighted what I highlighted is that you can see that based on these projections from our friends at Stansberry Research, which I think are reasonable projections. I might rebuild this so I can put my own kind of spin on it, but I think this is very reasonable and sensible, right? We'll see how things change going forward, but the underlying math makes sense to me. For what everybody wants to know is, when's the Fed actually going to back off? I've mentioned it a bunch of times, like when I keep saying, don't get bullish until the Fed backs off. Don't do this until the Fed backs off. Rates are going to keep going up until this and this. Well, when is that likely to happen? May is my best guess right now. That's when the real Fed funds rate, which means the overnight lending rate minus the CPI or inflation rate, is a positive number. And based on some very reasonable expectations, that is projected to happen in May of next year. So we got, a little over 6 months, 7 months maybe until that happens. And so that's why we're buying 3-month and 6-month treasuries primarily, some 9-month as well. But primarily is we think we're going to want to take some of that money and buy the stock market by the time May of next year rolls around. So that's a long ways out, and a lot can change between now and then. But if you asked me right now today to bet on when the Fed would stop hiking rates, this is what I would bet is probably, maybe April is probably what I would bet, because I think this might be a little conservative. But I wouldn't be saying November of 2022. I wouldn't be saying January of 23. I don't think that's reasonable. I think that's incredibly aggressive to think they'll be done by then. I don't think inflation's going to fall fast enough, and I don't think they're going to hike rates fast enough in order for the real rate, which again is the Fed funds rate minus CPI, to become positive. And the Fed has never stopped hiking with the real Fed funds rate as a negative number. So maybe they'll do something unprecedented. That's always possible too. If they do, though, if they do stop hiking early, inflation will just ramp up, and they'll be right back where they started. So I have a feeling, again, if you made me bet right now, I'd bet on April or May of next year is when the Fed will finally back off.
Mm-hmm.
So
So
that's what this is all about.
we'll see. And it's always hard to know right when stocks will bottom relative to that, but that's certainly a data point to pay
Yeah, I
attention
was
to.
looking actually for something to put in here. I couldn't find it in enough time, but the past 7 hike cycles, I guess the past 7 bear market bottoms, maybe it was, didn't bottom until after the Fed stopped hiking. The market did not anticipate it, even though the Fed will be talking about how they're going to stop for months probably before they actually stop. The market has never actually anticipated it. I have data on that. I'll look for it to put in next week's call, because I want to write about that in my upcoming market commentary too. But I couldn't find the backup for it, so I didn't want to put anything in here without having a very clear message. But that's what I understand from what I read before, is that the market has never actually anticipated that happening. So
Mm-hmm.
once the Fed starts maybe cutting rates, that's when the market is like, oh wow, we can buy stocks again.
Yeah.
So we'll see.
And then this chart here, so showing seasonality, and just so everyone knows what seasonality is, if you took every traded year in the market and looked at each month, so first day of the month to the last day of the month, and looked at all those data points or all the years to see, did you rise on average up or did it go down, and by about how much? That's what this is illustrating, right, Shane? So,
Yep.
this usually mid-October is the low point, and this is always called the Santa Claus rally. That's at least what I know it as, is rallying to Christmas. So you can go buy a lot of toys. We'll see how this year shapes up. You can also go that way. So it's just that on average, it goes up more often than down.
Yeah, I figured given how bearish we are, we might as well put at least one bullish chart in the mix for this week. This is the most bullish thing I could find all week. So, I think it's important to note that, like, just because I'm bearish and I see nothing but, bad news and no reasons to be bullish, it doesn't mean I'm not looking. I'm always looking for where I'm going to be wrong. I'm always testing myself to see, like, what's the inverse of my idea? Where am I going to be wrong? Why am I going to be wrong? Who is it out there that disagrees with me, and why? Do I respect that? Does it make sense? And, sometimes it does. Like, this might be a good reason to buy some stocks for a rally, but I don't think it's a good reason to go, like, put all your money into the NASDAQ on October 13th. Maybe you want to add a little bit. Maybe you don't want to do anything with it, but it's just that it's something out there that is contrary to my own personal understanding of things, and I think it's important to test our ideas against other data points. So
That's right.
that's it.
So the key to always being successful is try to remove that bias as much as you can and just go with what the market's telling you. So, and then Shane, what do we have here?
Yeah, I think we're almost done, so we'll try and make this a little snappy. But this is a chart from August 5th. So this was in our chat on August 5th, and on the right hand side, well, first you see the green boxes coinciding with tops. So when the dumb money was more aggressive than smart money, those coincided with tops in the market starting this year and during this bear market. Every time like the bottom chart where the red line would get above the blue line and those green boxes, that represented a top in the market. And on August 5th, it looked like it was, the blue line and the red line in the bottom chart were converging again, and the red line was about to go, above the blue line. And was that going to coincide again with another top in the market? I had a little question mark there, because it remained to be seen what would happen with that. And subsequently, the market actually kind of bounced, took one more leg higher. But if you go to the next chart, Kyle, I've updated it to reflect where we are now. And so that third green box and red arrow is the same as the one on the prior chart from about August 5th. You can see the market bounce one more time, just above 4,200 from there, but it was pretty close again to nailing, the third top. So I look at that as actually, pretty close to accurate. If you had shorted the market right there, you would have stopped out of your shorts, and you would have been wrong for, maybe a week or so. But very, very soon after, I think August 17th, the market did make its most recent high and has done nothing but drop since then. So, so these signals aren't perfect, but they are indicative of what's going on in the market. And when the dumb money, in this case, retail investors and speculators and hedge funds, when they get more bullish than, the smart money, the hedgers, the people who are actually operating businesses and know what's going on in these markets, it's a sign to kind of take notice and be cautious. And again, just like the prior slide, we don't base anything on one instrument and make, big bets based on that. But turns out that this was pretty darn close to nailing another top during the bear market.
Yep. And then this one here, what are we looking at?
Yeah, so what this shows you is that you don't always want to be contrarian at extremes. So on September 9th, institutional traders had bought more put options betting that the stock market would go down than ever in the history of the universe. And normally when that many people are all sure something's going to happen, they're wrong and the market will inflict massive pain. What you can see here is that the following day, the market went higher for only just that one day and then gapped down big time. When Jerome, well, no, that wasn't the Jackson
That
hole.
was
That
the
was when they
CPI
actually,
print.
yeah, that
I
was
think.
CPI came out. So the next day we got a gap down and the market's done nothing but go lower since then. So it turns out all these people who bought all these put options ended up being right. And that's just, it's something to take note of. Like sometimes the herd is correct. And you don't always just because somebody told you to be contrarian, or when most people want to do something, they're usually wrong. Like all that's really, pretty true, but nothing is 100% in the stock market. There's no 100% accurate indicator. That it just doesn't work that way. Just like in the previous slide we looked at, you'd have been wrong for a couple of, actually about 2 weeks, you would have been wrong. And then it turns out that, it was just a little bit early. So in this case, it didn't nail the top exactly. A lot of the people who bought all these put options on that day, September 9th, they probably did sell those for a loss the following day as the market went higher. And as that positioning unwound itself, the market dropped the following day. And a lot of these people, were very, very close to picking the actual top of that move. And so sometimes the herd is correct, and sometimes you want to bet with the herd. Like sometimes it's that obvious and everybody knows what's going to happen, and you want to be with the herd. So again, there's no 100% accurate indicator in markets. Doesn't matter who's teaching you the setup or how good they are at it. There's just nothing that's a sure thing.
Yep. And that's where risk management is always so important. Keep the loss small. If you do that when you are right and when that indicator works, you can make some real money. But if you're wrong,
Imagine how mad the person is who covered, or who sold their puts the next day on that little bump, and then like they look back and they're like, "Man, I was right, and I chickened out."
and then Shane, just to wrap up here, we got the Babylon Bee here with some insightful wisdom.
Yeah, I threw in the hurricane one just because obviously I didn't prepare very well for this call today. We've been a little bit preoccupied preparing for a hurricane, and thankfully it came in a little bit south of us. Thankfully for us, but bad for the people down south. So I have a hard time being thankful for that. But anyway, yeah. Thought this was a funny headline related to the hurricane anyway. Authorities warn that hurricane could cause Florida to have as many water and power shortages as California. Um, so that's funny. And lots of people are without power, so it's probably not funny to those people. But since they don't have power, they're not watching this.
Yeah.
Yeah. So, and then on the not the Bee, right, the actual news, the non-satire sister of the Babylon Bee. I thought this was amazing. This was actually today's headline. So maybe the Washington Post put this out yesterday, but they're literally trying to spin 7 ways that a recession could be good for you financially. And I haven't read the article, so I'm not sure how asinine it is, but I'm sure it's just ridiculous. I'm sure of it. And
Yeah.
of course they got Mr. Bernie with his laser eyes on there, so very funny stuff. But yeah, I can't imagine 7 ways a recession could be good for you financially. Can you weather the storm? Sure. If you are positioned appropriately and hold lots of cash, will you get to buy some things at, good prices? Sure. But I think we'd all rather not have a recession.
Exactly. We want people having jobs, being happy out there, and hard to argue that it's good for anyone other than those that have a pile of cash ready to invest at some point. So, hopefully things get positive, but right now just not seeing it. And it looks like market's rolling over just a little bit since we started this call. So
S&P 500 is down 2.32% for the day. NASDAQ is down 3.25% for the day. Russell down 2.88% for the day. None of that's good. None of that's good. That's what you're going
no,
to get during a bear market with a recession. And there are not 7 ways that that's going to be good for anybody. Promise.
nope. And after yesterday, just unwinding that rally from yesterday, my vote right now is we might be trading lower when we meet again next week, but we'll see.
Yeah.
So you never know, but it is very hard to get a sustained rally right now, it seems.
Yeah, this is brutal. Brutal.
So awesome. Well, Shane, thanks again for your time, and I'll see you next week.
All right, man. Take care. Thanks, Kyle.
You too. See ya.